President Obama expressed his faith that the economy is on the mend while addressing his supporters after winning re-election last night. But as he heads into his second term, he faces a number of challenges, including high unemployment and slowing global growth. But the most immediate priority is reaching a budget deal with Congress in order to avert tax increases and deep spending cuts starting in January. Joining us this morning, financial advisor Lance Roberts, who is with Street Talk Advisors. Lance, without a budget deal by year's end, and keeping in mind we don't have a lame duck Congress, the combination of spending cuts and tax increases of about $1 trillion will start to kick in. What are the consequences if they actually do occur? And how likely is it that some type of a deal could be reached?
Well, I think, well, first of all, let's answer the first question. If the tax fiscal cliff occurs, in other words, all the tax cuts from Bush go back to where they were, the sequester that was put into place after the last fiscal ceiling deal was put into place, those sequester job cuts hit mostly in the defense sector. If all that occurs, you're looking at about a 3.5% to 4% clip to GDP. So currently right now, the gross domestic product is running about 1.5%. Subtract 4 from that, you've got a very nasty recession in the United States here next year.
You mentioned defense cuts. We are now out of Iraq. We are winding down in Afghanistan. Economists have to be looking at this as something that's going to be positive for the country because money, instead of going out, paying for defense hardware, is going to stay here in the nation.
You would think so, but that's not actually the case. Let's take a look at the third quarter GDP, just was announced here last month. Third quarter's GDP came in at 2%. Subtract out government defense spending, which came basically out of nowhere, $30 billion. Strip that out, we had a 1.3% economic growth rate ex-defense spending in the last quarter. Defense spending is a very huge component of government spending, so cutting those defense spendings is going to drag on economy.
Economists have said they only expect the economic growth to be about 2.3% next year.
That's highly optimistic.
Pardon?
That's highly optimistic.
Well, you have to be optimistic.
Sure, I understand.
We are the United States.
Yes.
We are a country of optimistic people.
Exactly.
You know, Europe is having its financial problems. How is that affecting our economy, and is there anything that we can do about that?
Well, no, and look, this is the thing, and that's why I said, 2.3% is highly optimistic. The reason is that the recession in Europe and the slowdown in China has a huge impact on something that we do here as businesses. We export goods. Exports now make up more than 13% of gross domestic product. That's the largest level in history. Housing and automobile manufacturing, which used to be the leaders in our country, now make up less than 2% of the economy. They're very small constituents. So the slowdown of exports that we're shipping out to the recession, because of the recession in Europe and because of the slowdown in China, is impacting corporate profits. Exports make up more than 40% of corporate profits. So you can see why that is very, very important here about our manufacturing capability and our export capability. It will drag on the economy, and that's why we're looking at probably somewhere around a 1.5% to 1.8% growth rate next year in the economy at best, and that's assuming we can get the fiscal cliff problem solved.
Joblessness, 7.9% nationwide. In the next 4 years, is the president going to be able to take it down to 6%, which some people consider normal?
Well, yes. The question is, how do you count unemployment? This is the big issue. The reason that we've seen the unemployment rate drop from 10% earlier in 2009 and 10 to where it is today is primarily because people are leaving the workforce. We have 10,000 people a day leaving the workforce theoretically because they're retiring. However, there's many retirees that are still working well into their retirement years because simply they can't make ends meet. So we may see a lower jobless rate, but the problem is that the jobs we're creating are low wage paying and primarily temporary work that have no benefits, and that's going to weigh on economic growth because people simply don't have the consumption to do. What's more important than employment is wages. What are people getting paid? Wages are declining on a year-over-year basis. Net worth of the average American has declined over the last 12 years, the longest stretch since the Depression. That's what creates economic growth, is what people are making.
You don't see a turnaround at all in the next 4 years?
Not right now. There's nothing to promote it to turn around because right now we're stripping the ability to grow the economy and we're shipping it overseas because of the coming health care taxes, because of the situation about rising taxes potentially in the economy that keeps people from spending money. This is why corporations are sitting on $16 trillion in cash and they're not spending it, because there's no aggregate demand from consumers and there's nothing to turn that around.
Lance Roberts, Street Talk Advisors.
But I'm very optimistic.
Depends on who you talk to.
Exactly. Thank you.
President Obama is going to serve a second term as president. He's promising to make jobs his #1 priority. Here to talk about how the markets are reacting, or how badly they're reacting, is Lance Roberts. He's the host of Street Talk Live on KSCV Radio, and of course he has StreetTalkLive.com. So Lance, the markets are not liking something this morning. The Dow is down about 200 points or so.
Right.
Why?
Fiscal cliff issues. The one thing here that is going to be a problem coming up is this idea of the fiscal cliff at the end of the year, which is basically the expiration of the Bush tax cuts, the sequester of jobs from the Defense Department that was put into place, and the tax cuts that were put into place after the debt ceiling deal last year. And then, of course, 22 new taxes coming in to the middle class from Obamacare. All that's going to hit next year. And as that comes to roost, that is going to basically detract from the market. We're going to have a GDP running basically at -2%. That's going to be bad for the economy. So that's what the markets are saying now, is that because we have a democratically controlled Senate, a Democratic president, and a Republican House that has vowed to basically be the defense line against Obama, we're looking at another gridlock situation going into the end of the year.
Well, the last time we had gridlock, or a major gridlock, when we came to the debt ceiling debate, you know, I believe, what was that, the summer of
2011, yeah.
Yeah.
It was hard to believe, just last year.
Yeah, the market went nuts. I mean, it just went down and down and down because investors don't like one of these protracted stalemates.
Sure.
If that happens again, and there is some kind of panic, would that be a time to buy in, or is it time to run for the hills?
Well, it's never a time to run for the hills. And look, managing money is about managing risk. That's really what it comes down to. And when you have big contractions in the market, those do provide buying opportunities. It's just understanding that in order to take advantage of that buying opportunity, you've got to have some cash. So, you know, these ideas of being buy and holder investors and just buy stuff and sit on it and watch it go up and down, it's not going to work long term, because we're going to continue to have more often rolling recessions because of where we are in the economy. During a recession, you lose 30% of the value in stocks. We're likely to have a recession next year. So, you know, the markets are going to revalue and reprice. Of course, we have all these artificial programs, from housing to quantitative easing to boost bonds and to boost stock prices. But, you know, we have a real recession issue in Europe. We have China slowing down. That's impacting the U.S. economy here. Job growth is very tepid at best, and it's in the lowest wage-paying categories, which is reducing incomes for the average American. That reduces consumption, which slows the economy. This is all tied together.
Vicious cycle.
It's a very vicious cycle, but the point is you're going to have to really be a lot more careful about how you manage your money and where you invest it.
Well, and let me just throw in a shameless plug here for a second as we check out the Dow down now 234 points. If you subscribe to the X Factor newsletter, as I've always told you to do, from StreetTalkLive.com, you would have known to have some of your 401k money allocated into cash so that you have an opportunity to buy in.
Absolutely.
Okay, there's a shameless plug for Lance.
Thank you.
All right, let me play devil's advocate here for a minute, okay? President Obama is a very smart man.
Right.
Very smart, okay? He surrounds himself with very smart people.
Okay.
They must know this, don't they? I mean, I've heard you say time and time again that once we pass this fiscal cliff, it's going to have this huge hit on the gross domestic product of the country. They must know that, don't they? I mean, there's got to have some plan.
Well, they do. And you have to remember, it depends on what your goals are. And if your goals are to use more government intervention, to have the government deeper into the average consumer's wallet through food stamps, through disability insurance, through government support, extended health care benefits. In order to have that, you need economic recessions, because you need to create that need for government growth so they can spend more, so they can promote more of their government programs, for green energy, to all these other things. Whether you agree with the programs or not, it's irrelevant, but that's what the program. So yes, they do know what's coming up, and they're okay with that because it plays into their long-term plan of being able to promote their agenda. Whether you agree with it or not, that's the plan. And of course, the Republican plan is to cut deficits, cut budgets, reduce spending to try to get the economy back on the right track. That also has negative consequences for the economy. It's just a different agenda.
Right.
Yeah.
Okay, so if you had to make a prediction, do you think that our leaders in Washington are going to get this thing solved before the crisis hits, like before the end of this year or the very beginning of next year? Or are they going to as some of the politicians have said, let us go off the cliff and it becomes a crisis, and then you can get something done. Because a lot of times, if there isn't a crisis, these guys don't get anything done.
I agree with the latter point, and I do think that'll be the case, is that we have a lot of talk about it. Nothing will occur. We will go over the cliff, and then when the crisis occurs, that's when they will sit down and actually come to the table and cut a deal, which will result in higher taxes for the average American, both middle class as well as upper class. It will result in some new measures about creating more revenue for the government. Understand, though, that this will limit job growth and it will limit economic growth.
All right. Wow, I feel very enthusiastic about 2013. All right, well, coming up next.
But I'm very optimistic about 2013.
All right, good.
I said that earlier.
Sign up for that X Factor newsletter, StreetTalkLive.com.
Thank you.
Coming up next.